Two people walk into a bank on the exact same afternoon. They each sit down at a desk and sign paperwork for the exact same $50,000 loan, locked in at exactly 7% interest. Fast forward a few years, and the results are completely opposed. The first borrower is buried under payments, struggling to stay afloat. The second borrower walks away richer than when they started. The math governing this outcome ignores the size of the loan, and it ignores the interest rate. Both borrowers started with the exact same variables. The difference comes down to how they handle the cash itself. At its core, a loan is simply a process of renting money. You borrow a lump sum, you hold it for a specific period of time, and you pay a fee for the privilege. That fee, the interest rate, is your rent. Consumer finance teaches us to avoid debt to stay safe, but the mathematical reality is that wealthy people actively seek it out. They just ensure that the money they rent goes out into the world and earns a higher return than the cost of the rental fee. This animated equation shows us exactly how that works. We call this the spread. It is the precise gap between what the rented money earns out in the market and what it costs you to hold it. If you rent cash at 6% and it yields 10%, you capture the 4% difference. But the spread is only half the equation. To calculate your actual return, you have to multiply that spread by your leverage. Leverage is a simple ratio. It measures how many borrowed dollars you have stacked on top of every single dollar of your own personal cash. If you can entirely remove your own money from the deal, your denominator drops to 0. Divide by 0, and your mathematical return on cash becomes infinite. Let's track how this operates in the physical world. Almost every major retail business relies on trade credit. When a company wants to sell a product, they rarely pay the manufacturer upfront. They negotiate net 60 terms. This timeline maps out the transaction. The manufacturer ships the inventory, effectively lending the product to the business on day 1. The business has a 60-day window to pay the invoice. If they sell the inventory to retail customers by day 45, they collect the revenue 2 full weeks before the bill is due. On day 60, they pay the manufacturer and keep the profit. Look at the resulting data here in that final 15-day window. The business never locked up a single dollar of its own capital in that pile of inventory. Their personal cash in the deal is 0. The yield is infinite. You can apply this exact logic to a digital service business. Imagine a marketing agency selling a $5,000 ad campaign. Instead of paying expenses out of pocket, a sharp operator requires a 50% deposit upfront from the client. The agency then puts all the software subscriptions and freelance labor costs onto a business credit card with 30-day repayment terms. They use the client's initial deposit to fund the daily operations and let the credit card float the ad spend. When the project wraps, the client pays the final invoice, settling the credit card balance before any interest accrues. The entrepreneur secures high-margin revenue without risking a dime of their own capital. They use the client's deposit and the credit card's terms as the rented money. Real estate investors use a similar mathematical structure to recycle capital through hard assets. It goes by the acronym BRRRR: buy, rehab, rent, refinance, repeat. Let's break down the variables on this diagram. You purchase a distressed property for $500,000. You put 20% down, that is $100,000 of your own cash, and you take out a bank mortgage for the remaining $400,000. Next, you spend $50,000 of your own savings fixing up the house. Your total personal cash in the deal sits at $150,000. While renovating the property, you force the market value to appreciate, pushing the home's total worth up to $700,000. You place a tenant in the home to generate rental income, then immediately go back to the bank for a cash-out refinance at 80% of the new value. The bank cuts you a fresh check for $560,000. You use $400,000 of that new check to pay off the original mortgage. Look at the remainder isolated on screen. You are left holding exactly $160,000 in liquid cash. You put $150,000 in, and you pulled $160,000 out. But the $10,000 profit is a distraction. The mathematical victory is that you extracted every single dollar of your initial personal investment, driving your leverage denominator back to 0. You still own an appreciating asset, but you now have your original cash back to buy property number 2. But infinite leverage carries a heavy mathematical consequence. Compare the two loan masses on this scale. Your new mortgage balance is significantly larger than your original loan. You jumped from owing $400,000 to $560,000. Even if the interest rate stays perfectly flat at 7%, that expanded principal drastically increases your monthly payment. The rent on the borrowed money just went up. This is where the strategy breaks. If the monthly rent check collected from your tenant is smaller than your new, heavier mortgage payment, the math inverts. The cost of the rented money now exceeds what the money earns, creating a negative spread. A negative spread quietly drains your personal cash reserves to cover the shortfall every single month. When those reserves run out, you miss the mortgage payments and the bank repossesses the property. Access to leverage determines how fast you can acquire assets, but the spread determines whether you get to keep them. Ensuring the rented money earns more than it costs is the only way to survive the debt and actually keep the wealth you build.